Welcome to the Financial Planner Life podcast. Today I'm joined by Andrew Spence. He's the co-founder of Aspen, a new model portfolio service in one of the most competitive areas of wealth management. Andrew's story isn't typical. He started in marine engineering, faced a life-changing cancer diagnosis, and came out the other side determined to do things differently in this industry. Now we're going to dig into why he launched Aspen in such a crowded market, what makes it different, and then we're going to get into some quick-fire Marmite type topics Andrew's known for debating on LinkedIn. So active versus passive. Do you really have to choose? Evidence-based investing. Is it real or just the buzzword? Risk profiling. Why do advisors hate it? And we're going to look at Bitcoin, gold, private equity. Do they belong in a client portfolio? And of course, LinkedIn. What works? What doesn't? And how he has been using it and some of the success he's had. Now we're going to finish by looking ahead. Well, what's next for wealth management? What actually matters to Andrew now? So let's get into it. Andrew, thank you so much for joining me today on the Financial Planner Life podcast. It's a pleasure to have you on. We've got to know each other for quite a long time. I've seen your journey from the very beginning, and I spoke to you back then. And to see where you've gone today with Aspen is phenomenal. And I think the future's looking really bright for you. So today it's about finding out about your journey, where you're going, what you do, and let's take a look at some of those Marmite topics out there about MPS and see what people are saying and see what your thoughts and feelings are about it. So in the first instance, can you just give our listeners a bit of an insight into who you are, where you came from, how you got into investment management?
Great to be on, Sam. I've been looking forward to this for many weeks now. So it's great to finally be doing it. So the journey into wealth management for me. So I studied engineering at university. And one of my issues with the engineering discipline, why a lot of people actually don't stay in engineering, is that it's very theory-based and there's very little practical elements to it. Like I did marine engineering and, I wouldn't have known the first thing about stripping an outboard engine when I kind of came out of it. So yeah, so you do see a lot of people actually leave the engineering discipline. And I think it's because of the lack of the practical elements to it. But it was 2006 or so, and based up in Scotland and Edinburgh. And Edinburgh has quite a thriving sort of asset management and wealth management. I think it's the fifth biggest asset manager city in Europe, actually, Edinburgh. So it's a big financial centre. And 2006, everything was going well. Obviously, 2 years prior to the financial crisis, and I went for an interview. I was looking for jobs as we do when we leave uni, and went for an interview with a wealth manager called Gerard at the time, and got the job. And like it is, in professional services, you start a job, you start doing exams, and that's you now in the industry. And so I was starting in Edinburgh, and then after a few years, I moved down to London in 2010, and became sort of head of fund research for Williams & Bro in London. And then I was there for another couple of years before moving to the West End in 2012 and joining a small firm to set up an MPS, to co-set up the investment side of a business and doing model portfolios. And that was really in the early days of model portfolios. They're really just kind of getting going. Then previously things were very much full discretionary bespoke. And so that was the starting point of my model portfolio kind of journey. And so I was there for about 6 years. And as I was kind of coming to the end of that, I was in London, had a small health issue, which was an episode with cancer. And I think that was me 10 years into my career, and it was kind of a kind of pivotal, transforming moment for me. I remember sort of being in the hospital, going through the treatment process, and the doctors and nurses would ask me, what do you do for a living? And I was like, I work in finance, but my parents are farmers, so we bring food to the world. I had this perception that finance, we weren't doing a huge amount of good. And the business that I was with at the time was a perfectly good business. We'd provide perfectly good solutions, but there was something in me that just wasn't comfortable. I didn't feel it was a very noble kind of profession at the time. And so that, was kind of that sort of 3 to 6 month period. I did, quite a lot of thought in terms of what the future looks like kind of beyond the treatment process. And so it was a couple of years later in 2019 that I then, left employed work and looked to set up Aspen. And it was really to create a business that patient in 2015, 2016 would be proud of, and to provide, investment services that the doctors and nurses would be great for them as well. So I think that was a bit of a seminal kind of period for me in terms of also wanting to create something and grow something, but to create something and grow something in financial services that created real value to the people that we provide our kind of solutions to. So that was kind of the background to Aspen, which was really properly started in sort of 2020 or so.
Love it. I think sometimes when we go through life struggles and strains and we're actually faced sometimes with death, we're looking at it, it can really kind of make you think about what it is you do and how you do it and the impact it's having on others. Is it purposeful? But often how we feel about it as well. Am I actually making a difference, and how am I making a difference? And I think we have to remind ourselves sometimes in the work that we do that where we may not feel it, it's the outwardly positive impact you're having on others. So one of mine was always this higher purpose of attracting more people to the financial planning profession through the Financial Planner Life podcast. If I always kind of have that as a shining beacon of higher purpose, positive impact, I can always turn to that and feel good. And I think we often kind of can downplay the value that we add and worry what people can actually think, right?
I totally agree with that, Sam. And my mindset has shifted in the last 5 to 7 years on that. I think, people's money is so important to them, and, looking after it and doing and responsibly, and people feeling that, they have financial confidence is such an important thing. Financial anxiety is a very real issue. And if you can, do things to improve that and, ensure that people have a good financial life and a good retirement, then, I think there's I think it's a very noble profession, done well. Yeah.
Model portfolio services is an incredibly crowded market. Whatever possessed you to get stuck into that and set up a brand new business in that space?
Yeah. So in asset management, it's actually very difficult to start from ground zero. A lot of people in the industry sort of spin off and or have like seed backers and these things. But I started Aspen. I knew the financial advice landscape, but I really only properly met one advisor once, and so I really was ground zero. We didn't buy any assets. We didn't do any deals. It was all about creating an awesome business and service proposition, and so yeah, it was going into, Elon Musk has a good saying on this. If you go into a new market with a lot of established and well-known competitors, your product or service can't just be a little bit better than those. It has to be quite a lot different and better for people to use you over the high street names that people are comfortable with. And I think that's particularly strong in financial services because people need a lot of comfort that their money is safe and kind of well looked after. So it's not easy in kind of starting a new business within financial services, particularly from scratch. And so it was really important that what it is that we did. And I knew the MPS space extremely well. I could see that everyone that was launching, people were falling over themselves to launch MPS because it was a big growth area within wealth management. But pretty much everyone was doing variations of the same thing. Let's just roll out another range of risk profiles, model portfolios, because that's what everyone else is doing. And that's reasoning by analogy, what everyone else is doing, rather than back to my engineering start, reasoning by first principles, which is what does the market want and people want and need. And so that's what I focused on. And it was really creating solutions around goals. What do people want? And a bit away from pure risk profiled kind of based model portfolio creation. So this notion that you as a client fill out a questionnaire, you come out as risk profile 3, you go into model portfolio 3, right, we're on to the next. I believe that clients have goals, dreams, needs, and objectives, And so we create the toolkit of portfolios that are able to deliver on those goals and objectives. And then we have great tech delivery and awesome service is kind of our kind of uniques in terms of what we offer.
I love that. Let's bring this back, because I always like to understand founders of businesses and their backgrounds and how previous experience impacts the new business that they're in and makes it unique, right? You're an engineering background. So just, can you give some examples of how your engineering background and mindset actually has shaped the proposition at Aspen? Some examples of that.
I think it comes back to, again, the first principles way of thinking. I have a fairly no-nonsense kind of approach to financial services. Is full of marketing, jargon. People, you roll out product. I mean, we saw in 2021, everyone was, again, falling over themselves to launch ESG products because that was the thing in vogue. And so for me, in creating the investment philosophy and the Aspen business, it was like, I've had, at the time, 12, 14, 15 years of experience in the industry. I had seen the good, the bad, and the ugly of what makes a great investment or what an investment solution should and shouldn't have. So for me, it was about, okay, that makes good sense, that makes good sense, and that makes good sense. It wasn't like, oh, let's go all in on that camp and ignore kind of the evidence over there. It was like, okay, let's pull in the evidence from all angles and create the ultimate kind of philosophy and flow. So I think that engineering kind of grounding of sense, logic, science was helpful in the creation of Aspen.
When you very first, you remember when you very first set it up, you were a few months into it, you invited me to come and actually see the end-to-end process of what an advisor would see as well. And I thought that was really slick. And I remember at the time thinking, this is slick, this is quick, and it's simple. I got it. I'm not a financial advisor, and I got it. How's that progressed since? And how does tech play a part in your business? Because tech can be massively overwhelming. There's a lot of it out there, and a lot of people just don't know where to start.
Yeah, it's a really interesting one. Financial services, we're pretty good at making complicated technology or complicated pieces of software. I'm a bit of a technophobe. When I get a new piece of software, I just want to be able to switch it on and start using it. I don't want to go through 10-factor authentication. I just want to, I want it to be intuitive and things. So for me, in building the software in Aspen, which we call portfolio discovery, and then there's kind of bells and whistles that have been added to that, but it's basically taking a financial planner and their client through an interactive journey of what their goals, what's their kind of wrappers, investments, options, risk appetite, and these sorts of things, and creating a lovely experience for them in the creation of a portfolio solution. And so the client goes away thinking, I really understand that, rather than this notion, again, like I said, here's your questionnaire on risk, here's your portfolio, here's the stack of paperwork, you're good. And so it was really trying to bridge that gap of financial literacy between, the investment side, the planning side, and the client's experience.
I think, how long have you been going now?
So properly for five and a bit years now. Yeah. So it was really the start of the pandemic that things kind of got going. Yeah.
Being a crowded market, being a tough market to win appreciation in as well, and recognition in with financial planners. They're a very critical bunch, aren't they? They can be, but let's think about what I'm not even think about, but what's your adoption been like in the last couple of years then? You've been going now for 5 years. It might have been a bit tough in the beginning. Most startups are, right? But over the last couple of years, have you started to really win over financial planners, and what's that looking like? Have you increased your client numbers?
Yes, this is such a interesting, and I feel, I'm so grateful for the early people that came with us in terms of, because we didn't give them any incentives. We didn't say, if you come with us, we'll give you X or whatever. And so, I remember our first clients, Richard at Clear in the Midlands, and then got to know a few firms in Edinburgh pretty well, and Carlton and Tom Ham and Wellington and the Ellis sisters. They've been huge supporters of Aspen and early in our journey, and then it's a bit of a snowball effect that starts to kind of build and stuff. We now have 60 firms that we work with around the UK. And I really love our clients. Like, I really enjoy spending time with them. They provide great feedback. Hopefully we provide a great service. And I'm loving the experience. I don't think, oh God, I've got to speak to that lot. I mean, you always have a few that you're, maybe a bit like, okay, well, that's fine. I mean, everyone has those clients. Financial planners will be able to say that client and that client, they're not the best, but they're fine. But I would say, on the whole, I truly enjoy spending time with the financial planners that we have. I think the industry has transformed in the last 12 years or so, and it's a thriving kind of industry. But and we owe a lot to, Lewis Brasso joined us 2 years ago now. He's done a tremendous job in terms of growing our brand and growing our presence. I think people need to see someone or a business something like 7 or 8 times before they feel comfortable kind of moving to that next stage. So it's been really important for us to kind of get out and about and be seen. So we're kind of on that, hopefully on that strong growth curve now.
Yeah, Lewis Brasso, what a lovely guy. I've met him numerous times. Really personable, cares a lot, asks really good questions, and he's just an interesting person to talk to.
He's been great.
Tom Howe, if he's an advocate of your business, of using it. I've known Tom for quite some time, since he started his business up. He came on the podcast a few years back. Really like Tom. Tom's no fool. Farming background like you, he's no fool. And if he's looking at Aspen and thinking this is the bee's knees and I'm using it and I'm an advocate, I think that's a really great voice to have behind your business. That from a social proof perspective, it's interesting you said people have to see things 7 times. I live in this world now of social proof. I'm the type of person that if I talk to you, I'm going to go onto Google and I'm going to search for you, or I'm going to go onto LinkedIn and I'm going to want to find some information about you. And it is interesting because we're saying it 7 times, and the people are making buying decisions before they've even spoken to the key person of influence within that business. They're making a decision as to buy by what the thought leadership is being said from that company or individuals within that company. Are they ticking the boxes? Are they providing me with an example of whether or not a client is using that, a client, say an IFA, is using your services? And what are they saying about it? How is it benefiting them? What was the journey like? So it's super, super important that when people do search and they do see those 7 things, right? Whether it's dripped over a period of time, so they get an email, then they go, oh, who is this person? Then they follow you on LinkedIn, and then they see something on LinkedIn, and then they might do a bit of searching on Google and find a YouTube video, or they might find you on my podcast, and all of a sudden that's a great affiliation. So it's really, really important that companies that are looking to grow their audience and grow client bases are being seen and heard outside of just simple reviews, like, advisors using your voucher. So I've got 1,000 people on voucher. Brilliant. That's one area. I do think with AI and, the written word is becoming so distrusted now that I have to hear and I have to see to be able to make a buying decision. I always use my daughter as an example. 9.5 years old. Dad, I want a bike. Great. Go and research bikes. She's not going on and reading about bikes. She's going straight to YouTube and she's watching some kid riding the bike and saying the story about. So everybody that's coming through now wants to see and hear something in action. I'm not going to buy a television unless some cool dude on YouTube has made a really good video about every aspect of it, and then I'll buy it. The written word's dying.
Yeah.
It's the video, audio, hear,
What's your view on the AI digital avatar of someone? Like, if you were an avatar today and we were having this conversation, how much confidence do you think people would have in that?
I think a lot.
Yeah.
I really do. And I had this conversation with a financial planner recently. If I can contact my financial planner 24/7, and it's a version of them and it's completely compliant, and I know 100% that what they're telling me is the truth, and at a point in time where I'm feeling anxious, it could be sat in bed at 10 o'clock at night, worried about my portfolio or money, and I can go in and I can ask a question. I can go through a contract and the contract reads it back to me with an answer based on what the question I've asked it. I think it's fantastic. I think it's a great addition to be able to be accessible to a client. And it's then an ability to create a level of service which is cost effective. Because if the avatar is able to answer multiple questions, then that's a cheaper level of service, hopefully, in the future for everybody involved, and making it more accessible. Different people require different levels of touch points. Not everybody has the time to sit down with a financial advisor or wants to sit down with a financial advisor. I'm not really that. I have a lot of questions, and I'm an emotional guy. So I want my kind of answers as quickly as I physically possibly can. And I've got no problem if there's a lovely avatar. In the beginning, I think these avatars are going to look a little bit robotic.
Yeah, right. Yeah.
Over time they're going to look fantastic. Now, do I want to tune into a YouTube video? Do I want to tune into a podcast with the perfect avatars talking back and forth to each other? Probably not.
Yeah.
Probably not.
Yeah.
Because they haven't built the businesses. It's the people behind it who built the business who then have built the avatar. So I want to know from that authentic conversation. So that's how I feel about it. I welcome it. And I love the idea of a Sam Oakes avatar at some point. I really do. So yeah, that's how I feel about it.
Yeah. Interesting. Yeah.
What about you're a vocal critic. You're an ambassador. Some of the big Marmite topics on LinkedIn. So let's fire a few of them. I've got them written down here as well. So active and passive investing. Do you think you need to pick a side?
Yeah, this is such a hot topic all the time, and to the point that people are getting a bit fed up with it. But it's I don't view it as active and passive. I view it as decision-making powers and no decision-making powers. So either you've passive, you've made a decision once. So I actually think all investing is a form of active decision-making. Like, if you buy Vanguard Life Strategy 60, for example, perfectly good option. That is an active decision to allocate capital on behalf of a client in a certain way. To say it's like, decision making is taken out or there's no investment selection there, it is a decision. And so the difference between active and passive from there is it's one decision and no further decisions. Whereas active management is one decision and the ability to make future decisions. So for me, that's the difference between active and passive. But I believe we're all in the profession of financial services actively making decisions on how to allocate capital on behalf of clients. So I actually, but within the uniqueness of active and passive, beyond that, you have, as I said, one decision, no further, multiple decisions kind of going forward. And then there's a whole spectrum in between. And often when we talk about active management, we talk about the security selection. So the picking of stocks. And there is reasonable evidence to suggest that that's quite a difficult game. And it's a zero-sum game in the fact that for every person making a right decision, there is a person making a wrong decision. And then if you take out the effective fees, on balance, you're going to be kind of losing if you have a portfolio of active funds. So that's at the one spectrum, is the full portfolio of active funds versus, I think where a lot of people landing are now is seeing a lot of the, cost and reliability in terms of market return performance of passive, and then maybe selective use of active funds. But what gets completely missed out of the conversation is the most important driver of a portfolio, and that is asset allocation. So everyone often on the active side, active passive debate focuses on security selection, where the real focus, and that's 80-90% of your return driver, should be on asset allocation. So you can actually have a very low cost portfolio and for it still to be active. So we have our passive plus range, which is flexible asset allocation and using low cost funds to then populate that. The thing then you need to avoid in the flexible asset allocation is the thing called market timing and trying to kind of pick and choose when you think a recession's coming and these sorts of things. But you don't need to do that. And, there's quite a lot of, in the pure passive camp, there's people out there that are quite rude, honestly, about people with decision-making ability. And my pushback has just been a little bit of a reality check that it is not, you don't need to go to that end of the spectrum. There is actually a middle ground that actually has, coming back to the engineering point, a lot of evidence and data around it kind of bringing value. So it's an interesting debate. I think it becomes too polarized. I think there is a sensible middle ground.
So picking a side then not need be, right?
No. No, I think it's interesting because people in the active camp see actually a lot of the benefit of using passive building blocks, whereas people in the pure passive camp think that camp's total idiots. And so, yeah, I think there is on the spectrum, full passive to full active. I think here is about the sweet spot, in my opinion. Yeah, but there's nothing wrong with pure passive or a more active solution, but I think the sweet spot is kind of somewhere around here. Yeah.
Yeah, it's not so black and white. It's a bit like the old IFA restricted debate, isn't it? Like people get so kind of bent out of shape and must be in one camp or the other,
Yeah,
and the
right.
other one's better. Like, there's a grey area in between. Someone said to me, like, Sam, you thinking black and white's a bit too much. And I was like, okay, well, how do I stop that? And they were like, one side's black, one side's white, and there's a shit ton of grey in the middle, different grey scale. And it's like, and now I often think, am I in black and white thinking? Where should I be? Am I in, the scale of grey in between? Can I move around? Am I okay to move up and down it? And I think it's worth it, isn't it, to explore it and to listen and to debate and engage and listen to the evidence for it as well.
Yeah,
and make a decision. Nothing should be so fixed. But evidence-based investing. So is it even a thing?
No, it's not. It's been a marketing term that's been created to convince people to kind of invest in a certain way. So again, this is something that I push back on quite a lot in the industry, and it comes from my engineering background, where evidence and science and data has a grounding in truth. And the reality is, an evidence-based portfolio, there is a near infinite number of possible allocations and decisions that are made in the creation of an evidence-based portfolio. So there is actually no central source of truth for an evidence-based portfolio. I first came across the sort of phraseology and the science behind it when I attended a dimensional conference in 2012, and it was exceptional. I have to say, I came away thinking this is a very, very sensible way to do things, and they talk about the evidence, and they have done a lot of work and a lot of great work over the last 50 years on understanding the movements in assets. They believe in the factors of value, profitability, and size, and there's some really, really sensible data that kind of sits behind that. I would say they're the closest there has been to sort of evidence, data, science-led investing. But unfortunately, a whole range of providers that piggybacked on that phrasing and then sort of started to describe their portfolio as evidence-based because it gives some scientific grounding, where in fact, it's just completely a marketing term. The principles of generally evidence-based investors is that a fixed asset allocation and using low-cost funds. That's kind of it. I could create for you today, Sam, in the next 15 minutes, an evidence-based portfolio. That will be different to someone else's, to someone else's, to someone else's, to someone else's. And so for me, it just makes no sense to kind of call it. It might be fine, it might not be. I think to think that evidence-based and this way of thinking has solved investing is complete nonsense. I need to come off the fence on it.
Yeah, is it just like a bit of a marketing term? Like people like to coin, yeah, it's just marketing term, right? It's interesting, grabs people's attention, you get in there. Yeah, it's clever though, isn't it, at the end of the day? Gets people talking.
It's not, the thing is, there's nothing wrong generally with the portfolios under an evidence-based banner. It's just, they're not evidence. They're just kind of an asset allocation that someone's decided, and they've decided on some index funds to populate it, and that's it. It'll probably be fine, but it's not evidence.
Okay, cool. So risk profiling, financial advisors, wealth managers seem to hate the process. So what do you think needs to change there?
Yeah, so risk profiling is another kind of interesting one. And I don't think this is too Marmite. It's one that advisors and us as wealth managers just really frustrated with the process. I used to have clients, and I used to have to go, give a client a risk profiling questionnaire, 10, 20 questions. I think one of them at the time was, how do you feel about being on a roller coaster? And so they're really quite awkward and tricky questions that are quite difficult and sometimes to answer for the client. So they're quite uncomfortable. the output generally isn't that helpful. And say you come out with say you fill in a questionnaire as a client, and you have a relatively low tolerance. You feel you have a relatively low tolerance for risk, and you might then answer a series of questions and come out 2 out of 5, Sam. But you have, and this is your pension that we're looking at. You have 30-year time horizon for that pension. So what we now have to do is we've gone through this process, and the FCA, it needs this process of risk profiling, and you've come out at 2. Now we need to go through the process of getting you up to a 4 or a 5, because that's where you should be. You should be having most of your money in equities, despite your risk tolerance being low. So we now have to go to an education piece of what it means to be invested. Volatility is just part of the journey, all that sort of thing, and to get you comfortable. But it kind of puts me at risk a little bit as an advisor, because you come out as a 2 and I'm trying to force you up, even though you should be a 4 or a 5. So the framing of risk and the word risk is used far too much in our industry, because risk is in fact staying in cash. Well, it's not if you've got a 3-year time horizon, but if your time horizon is 5 years plus, then risk is staying in cash. And so the framing of risk is done very poorly. From our side of the fence, in terms of asset managers, there's 7 main risk profiles out there. We need to write a check to them every quarter, a big check, for them to risk profile our model portfolios. It gets spat into some engine that they have, comes out, we get assigned a 3 for our portfolio. That 3 is 3 for that provider, it's a 4 for that provider, it's a 2.7 for that provider, it's 7 out of 10 for that provider. They're all different in terms of their methodology, in terms of how they score risk. And it's complete nonsense. It is complete nonsense. And so what we need, like we have for funds, is a standardization of risk across the industry for model portfolios and wealth management. And that's either 1 to 7, 1 to 5, 1 to 10. And we agree on what volatility bands or something like that is that risk profile. And then the providers can still exist, but we all base off that kind of simple risk profile. It's much simpler for the client and easier for them to understand. I was with an advisor the other day. They're transitioning from one provider, risk profiling advisor, to another provider. They both score out of 10. They're going to have to move the client from a 6 with one provider to a 9 with the other provider. And the client's going, but I don't feel like I've gone out 3 notches in risk. And they're having to explain it. It's 9. Yours is still the same risk. It's just we're using a different provider. It's extremely confusing for the end client. So really, I've got the end client in here in mind. But everyone in the chain, from us to financial planners, hate the process. And so we need a big radical kind of change in it. And when I put a couple of posts on LinkedIn, I get so many messages about it. I mean, it's a real issue. It needs to be directed from the regulator to produce a standardization. And then we all need to improve the process for the clients from there.
What about Bitcoin and gold? Should that be in a portfolio, do you think?
Yeah, so both have been raised. Again, it's a bit of we're generally quite used to bonds and equities as being the main asset classes in portfolios. And so the use of alternatives has come and gone over the years. If we were sitting here 10 to 15 years ago, you would have seen a lot more absolute return funds in there. So Standard Life GARS, for example, it had 65 billion of assets. A lot of that was financial advisor led. That was after we'd come out of an extremely difficult decade for equities. And so we'd seen other assets in there. Equities have had a very, very good run over the last 10 to 15 years since the financial crisis. And so that has been, we're understandably seeing a lot of assets turning into equities. Over the last couple of years, we've obviously seen Bitcoin grow in its popularity and its awareness. And obviously the price has been something that people are interested in when something is going up a lot. And then obviously in the last 2 years, gold has gone on a big tear, up from about $1,700 to about $4,000 today. And so people are obviously thinking, should I be including gold as part of the portfolio? It comes into the news, as does Bitcoin. And so advisors are kind of clearly getting questions on that. Ray Dalio, pretty sensible guy, running Bridgewater, or previously running Bridgewater. He advocates around 15% of your assets should be split between Bitcoin and gold. I don't think you have to hold them, but I do think we have a 4-season strategy, which is basically the ultimate diversified portfolio. We do have a 7.5% neutral weighting in gold in that. And so, we're seeing monetary debasement at the moment of fiat currencies, and gold is the sort of beneficiary of that. And so, I think gold probably does have a place it depends on the mandate of the portfolio. But if you're looking for an ultra diversified portfolio, then gold has a position in that. A 60-40 portfolio of equities and bonds equally is a fine option. But I think completely discounting gold as a silly asset that you can just look at and it looks nice back at you is not necessarily the case. I think it has an absolute store of value, and I think it should be considered as part of a portfolio. Yeah. Bitcoin obviously is one that we've now, regulations have been eased finally after the 10,000% rise in Bitcoin for investors, probably be the top, that investors are now able to buy exchange traded products in Bitcoin and Ethereum. I think at the moment that's regulation that's come into place this month. So it is now an investable asset for us to consider. I think it probably will be some time before you start to see it more in portfolios, if at all. We'll see how that all pans out. Yeah.
Well, big shout out to that Bitcoin IFA. I spoke to him a little while back, and maybe he's been quite ahead of the curve on this one. But he's going around and having conversations with financial planning companies. He's running presentations, seminars, training sessions about how to have the conversation with the client and how to approach it.
Yeah.
So if anyone's listening to this and they're unsure about how to do that, or whether they should or why they should, check out the Bitcoin IFA. I know he's got a podcast, and he's definitely somebody to probably get into your business and run a few training sessions. And he seems to know his stuff.
Yeah, he does. I've spoken to him as well, and I think he does a combination of in-person training sessions, or you can subscribe to webinars and things. So yeah, he knows his stuff, and definitely worth exploring, understanding, and then discounting if you wish, but at least kind of going there and considering. Yeah.
What about private equity? Should financial planners be considering this?
Yeah, so it's another one that has, I think people are quite disparaging of the use of private equity in sort of client wealth. I think the issue with private equity is liquidity. It's very illiquid, but that's the nature of it. The lockup periods are there. I run a private business. If we had to offer daily liquidity for people, that would be difficult, but I think we'll bring a lot of value to shareholders if they're happy to, stay in for a period of time. So that's the nature of private equity. You do need to be locked in for a period of time. But it is an issue if people are needing to buy and sell from their portfolio. So that's one issue. There is then sometimes the professional upgrades that you need to do for clients. There's a lot of paperwork that comes with private equity. There's a lot of opaqueness in terms of what you actually hold. And then there's this mark-to-market issue. If you do get a market fall, it still prices at that current level. And I think people find that a bit tricky as well. So I think under its current structure, private equity is a real challenge. There's just a lot of barriers and friction points for financial planners to access it. I think the transformation will probably be when tokenization improves and you can actually hold elements. If you consider the property I'm in at the moment, or a private company, if you have an easier way of buying and selling those the component parts, the shares in that illiquid asset, I think that really improves the ability to access private equity. But I think that's going to be a few years away yet.
Love it. Well, listen, thanks for answering those questions. I want to move on to LinkedIn now, because you've actually been quite active on LinkedIn. I would say probably within the last 12 months, more so than ever. It's a great place to have discussion, and it's a great place to bring up those Marmite topics and get people involved in expressing how they feel. But I'd love to know, as somebody who's now adopting LinkedIn in part of your networking, marketing, how are you finding it?
Yeah, the LinkedIn journey has been an interesting one over the last 12 to 18 months. I didn't consciously decide I'm going to start posting on LinkedIn. I think it's quite obvious when someone does that. You get like 2 weeks worth of lots of posts and then they sort of fall away. And so for me, it was more, I've been on LinkedIn for a few years, but then there was just things on there that I was like, I don't know if I fully agree with that. And so I wanted to start to be a bit of a voice for for a certain section of the market that perhaps had a healthy debate with another section of areas in investment management. And so I think it's been a tremendous. I've thoroughly enjoyed the LinkedIn journey. I've met some really interesting people both online and IRL, and so it's been great. And I think I think the great opportunity on LinkedIn is authenticity. I think because everyone sees it as a work platform, so everyone kind of moves away from their true self into sort of work mode, and then sort of writes in work mode. But if you can actually be authentic on LinkedIn, and respectful in these sorts of things, then I think that's the real kind of opportunity on LinkedIn. So I really enjoy it. I really enjoy the debate and discussion, and it's managed. LinkedIn's done really well as a social network to not descend into the Daily Mail comment section or other social media platforms where it's just like a slagging match of stuff. So it's a really great platform for debate and discussion. And as a byproduct of that, you build your brand and you build the brand of the business and these sorts of things. But that wasn't an objective for me, but it has been a byproduct of the whole thing. What about you, Sam? I mean, you obviously do a lot on LinkedIn as well. How have you find it, and you're more in other channels of communication as well. Where do you see LinkedIn's place in the industry?
Well, apparently 1% of all LinkedIn members actually post.
I read that last night as well.
Yeah, I think we're in a bit of a gold rush when it comes to LinkedIn. I think what people struggle with is how to position yourself. So whether that's how you position yourself when you're working for a company, or how you position yourself as a thought leader for your own company. Like, how are people going to take you seriously? Are they going to dislike you if you put an opinion out? Are you going to put people off? And I think there's a lot of worry, there's a lot of fear, and there's a lot of anxiety as to why those people are. And they're the reason. Where it is an education piece. Like, you can come across as a dick on there without a shadow of a doubt. And I've seen it. And I've advised certain people to not put too much out there that's going to make them come across the wrong way. You still have to protect your brand, and you still have to have like kind of PR experience, I would say. And there's a ginormous risk of really kind of alienating yourself with people. So you have to be quite careful, and you have to tread carefully without being somebody that kowtows to everybody and a people pleaser. I think there's a style and approach to how you come across, and I think it comes also from the authenticity, not just picking. So don't just pick at things. You get people who are like, oh, I'll pick at that, I'll pick at that, I'll pick at that. And that's their strategy, to pick at things. It's not, if you're going to pick at something, come at it with something that's going to add value. Come out with something that's going to be educational as to the reasons why. Can you see the positive in what the other person's saying? Can you expand upon that with your point of view that's going to hopefully create not conflict, but collaboration to move forward and take it up, idea forward. Nobody owns an idea.
Yeah.
And an idea isn't, there was an idea once that the world was flat. There probably is still with some people, but there was an idea that the world was flat, and now it's not. So without discussion, without engagement, it's never going to move forward. And I think if you're a facilitator of conversation and you are a facilitator of debate in a positive way, you will be seen as that. And people like to follow somebody who is willing to challenge as much as they like to follow the person who's going to just abuse people because it's just entertaining. But those people get boring very quickly.
Yeah, right.
Whereas the person who's actually forward thinking and willing to put their opinion out there in a constructive way, I think people respect. So I think it's about getting respect, and it's getting collaboration and competition going. And it's just making sure also you're having conversations. Because if you're not having those conversations, you're not going to be winning business. Now, a lot of us are on LinkedIn to be able to stand out and, let's face it, try to generate new business. And those conversations need to be had, right? So you need to be having a bit of engagement on, say, like a LinkedIn profile on your post, but you need to be taking that to the DMs as quickly as you possibly can. And you need to take a conversation into the DMs, and you need to take that conversation out of the DMs onto a Teams call where you can then really get into detail to know that person. And that's the way I look at LinkedIn. Now, the way to do that is to create interesting, compelling content that drives that awareness, drives engagement, conversation into DMs where you can take it off. So I just think people often live a bit too much either watching other people and not engaging enough, or putting content out and hoping someone's going to land in their DMs and then buy from them. That's not the case. Use it as a tool to outbound connect with people through the messaging, get them on the telephone and get them on Facebook. Because that's why I love podcasts, because podcast is all about sort of engagement. It's all about collaboration. It's all about learning. It's about raising other people up and not myself. So it's not an egotistical trip. And then it's about then content creation off the back of it. Because one video, one podcast can become 10 different assets, and there lies your social media strategy on LinkedIn that you're worried about. Like 1 hour session can be turned into a load of content. And the thing is with me is that I use LinkedIn, I use YouTube, because that's the fastest growing demographic is on LinkedIn, as well as the 50-year-old plus group, right? So from my perspective,
on LinkedIn?
No, it's on YouTube.
On YouTube, right.
Fastest growing demographic is 50 plus, which is why right now, for instance, as a financial advisor, if you're not considering YouTube as a platform for you to be talking about what it is you do and the problems and the solutions that you can offer people, and most clients are averaging around 50 years old in a client portfolio for a financial advisor, that's the fastest growing demographic. And they're not watching on their phones, they're watching on TV. So they're going from like iPlayer into YouTube and searching for the topics. So if you take a James Shack or something, or a Pete Matthew, they're doing phenomenally well on YouTube. There's lots of American guys and girls that are doing it as well. You flip all their topics of conversation on its head, and to see what the most top performing ones are. 80% of those is retirement planning. That's what people are searching for, is retirement planning conversations. And if you look at it, they're the top performing ones. So if you're going to set up a channel, you're going to create content, let's say as a financial planner, lean into that because that's the most searched. Lean into YouTube, because fastest growing demographic is 50, plus the 60 plus market is also really fast growing. And some of the top things they're searching for is finance, obviously, because they're at that age, right? They're at that age where they're going to start looking around. And again, so if you're creating something, I call it like video first marketing or podcast first marketing. You take a video, and then from there, you create your strategy.
Yeah. I think, Sam, and this is where I think you're in a sweet spot. I think it's a bit like AI. People know that they need to be producing more video content. People know that they need to be integrating AI into their business. We just don't really know where to start. On the video content side of things, where do people start in terms of the creation of content?
So you could use a platform like we're using today, which is Riverside. So that might cost you like £20 a month, I think it is, maybe even less than that, right? Buy yourself a good camera. I'm looking directly into an Elgato teleprompter right now, which is basically an additional screen to my computer. So I can drag my Riverside into here, look directly into my camera, and I can start to record content. I've got a 4K camera behind me with a nice lens. In total, that cost me about 650 quid, right? So Elgato teleprompter was £250. My microphone is a Shure microphone. You can't see it, but it's a good microphone. It's on a stand. So in total, my kit being at home, if I include my lights as well, is probably about £1,200 to get myself set up. Now, I'm then able to go onto other people's podcasts when I've got a lovely little setup, so I can be guesting on other people's podcasts. That's a great way to get yourself out there. And it's a great way to build authority, because if they're good podcasts, your name's attached to it, your company's attached to it, AI and AEO search will reference those podcasts that you're on up against the vouch for reviews that you actually have, and maybe some reviews and authority on your website, and go, this person's legit. And they're going to start to push you up the rankings, and you'll start to get found. So if you search for like financial planning career podcasts, I'm number one in the world on Gemini, which is, Google's. It's pretty sick, right? So when you buy the kits, you're thinking, right, I'm buying the kit, but what can I do with it? Well, one, set yourself up a podcast on Riverside, build your podcast. Now, using things like Buzzsprout might cost you, again, about £20 a month, right? And that Buzzsprout will distribute your podcast to Spotify, to Apple. It won't distribute it to YouTube, so you'll have to upload it to YouTube as well. I think be realistic with where you're going to start when it comes to content creation. I think one of the most untapped markets within financial planning right now is B2B. So if lawyers are your core subject, then go after lawyers. If HR professionals are, because you're a corporate you're a corporate employee benefits specialist, go after HR professionals, call it HR heroes, partner with an amazing HR influencer, and let's get HR people listening to your podcast, because that's who you want to listen. Turn those listeners into clients. So start thinking a bit strategically and logically about who you're trying to impress, who you're trying to target, and go after that and stick at it. It is consistency. So buy the kit, it's not expensive. Get a little bit of a strategy around, if I take a YouTube video like this, I could then outsource that to the plethora of people out there whose jobs are to edit stuff into clips and everything else for YouTube or for TikTok and all of that kind of stuff. Use that. Realistically, if you've got the time as well, right? Which is why probably don't commit to it every week to do an episode, maybe bi-weekly in the beginning. And then squeeze as much lemon juice out of the lemon as you possibly can with that one piece of content. Outsource it so you don't have to worry too much about it, and all you have to worry about is booking your guests in. But what I think people forget as well is that it's not about creating content and putting content on LinkedIn and hoping it comes into you, because you're hours doing that and nothing will come into you. I know that because for 3 years, nothing came into me. I had no inbound business for 3 years. Once you start to build authority and people start to see you, they start to trust you. So then you start reaching out to people, then they start to buy from you. So you have to use the video, you have to use your podcast, whatever you're creating as a tool to business develop. Did you watch this video? Can I invite you on this podcast? Oh, would you like to set your own podcast up? Would you be interested in a partnership with the Financial Planner Life? You're obviously keen to build video content. You don't know how to do it. I do an end-to-end service and take that stress and pressure away from you. And by the way, I've talked to you about my video first podcast strategy that will take care of all of your LinkedIn, and it's evergreen. So it continues working the year after as well. And people are like, oh my God, like I don't know how to do that. So it's about articulating what it is you do, connecting with the audience that you want to sell to, investing in the kit, understanding how to use it, and being consistent. And that, to me, is a LinkedIn strategy. Mm-hmm. Mm-hmm. Don't just watch other people engage. Engagement, even if you don't want to create the content, be somebody who engages on other people's posts, because the algorithm will reward you for that.
Sure.
And you will notice.
Yeah, I agree with you. Post and ghost or just not engage is not the strategy. The comment section is actually where quite a lot of interesting stuff happens on LinkedIn, and it's being used a lot more now, which is great. So yeah, I think it's a great forum, and I really enjoyed it.
Yeah, perfect. Well, Andrew, listen, great conversation with you today. Thank you so much for sharing your insights. And I think you've really touched on some of those Marmite topics with your viewpoints, and hopefully, fingers crossed, people will come back to you and they will talk to you and they want to understand a little bit more. They know you're a collaborator. They know you're somebody who's not arrogant. And the idea here is that you like to have conversation and welcome conversations from financial planners to learn more. And at any point, I assume they could come to you, have a demonstration, maybe a webinar, something along those lines. Can we take something, put it in the comments section for them to find?
Absolutely. There's obviously find us through the website and these sorts of things, but always happy and always enjoy, conversation around any of these topics, and obviously about Aspen and what we're doing here. But it's really just trying to anchor everything in common sense and things. There are actually a variety of sensible ways of doing things. There's definitely bad ways of doing things, but there's a spectrum of good ways too. So always encourage open-mindedness and these sorts of things too. So yeah, myself, Lewis, we've got Francis in the north as well now. So there's all sorts of channels that people can get in touch with Aspen there. But yeah, we can put something in the comments.
Brilliant. I always like to ask this question as well of anybody really that comes on the podcast, especially an engineering mind, future thinker, younger business owner. What do you think is next within wealth management and financial planning? We'll leave it on that.
Yeah, that's a big question, but I'll keep it short. So I think the last 10 years, 12 years, we've seen quite a lot of consolidation in the industry amongst financial planning and in wealth management. We've seen a big rise in indexing in terms of on the investment side. We've seen big cost pressures come on, certainly on the investment side, platform side, and the service and product side of things. So that's been the last 10 to 12 years. I think, goodness me, the next 10 to 12 years is going to be an interesting one. I actually think we'll start to see more deconsolidation. It's becoming easier and easier for people to set up on their own through networks and plugging into good technology and these sorts of things. So I think you do see these things go in cycles. I think we're going to see more of that coming. So I think we'll see lots of independence. And the big topic is the use of AI and technology as we evolve as a profession, both in investment management and in financial planning. I think financial planning is fairly well insulated for the next 10 years. I think investment management areas of it will be challenged by AI in terms of portfolio optimization and these sorts of things. But I think if you're open-minded and always try and keep on the front foot of things, I think we will. I think the good businesses will survive and thrive, and those that have their head in the sand will probably not. And so I think you've probably got to stay on the front foot of these things.
Absolutely, stay up to date. Andrew, brilliant talking to you. Thank you so much.
Thanks, Sam.